Calling someone who trades actively in the market an investor is like calling someone who repeatedly engages in one-night stands a romantic. Warren Buffett said that, and by his standards, I am probably the most romantic man on the planet. Now, I don't normally disagree with the big man, but hold on a second. Dictionary. To invest. To put money into financial schemes, shares, property, or a commercial venture with the expectation of achieving a profit. Ask a trader what they're trying to achieve. I'm pretty sure they have an expectation of making profit. How else are they going to fund those one-night stands? Today, I want to look at the difference between the two, because when most new investors approach this topic, the words trading and investing are often used interchangeably. But there are some key differences, and understanding them will help you decide which you want to be. My name is Tom Morgan from the YouTube channel That Finance Show, and I'm a financial advisor working today in collaboration with the fine people of Trading 212 to help teach you the basics of investing. You see right there, investing and trading in one sentence. It can all be a bit perplexing, can't it? You already know that nothing I discuss today is financial advice, but now that you're invested in the topic of this video, it's time to trade your ticker symbols for some trainers, because in order to really explain this, I want to talk about running. You thought I was going for a run then, didn't you? Don't be silly. No, I'm sat here because it was from this chair that I witnessed arguably some of the greatest series of sporting events of my lifetime, and I think they frame the difference between investing and trading perfectly. It's 2012, the year of the London Olympics, and against the backdrop of Danny Boyle's epic opening ceremony, and whatever this was from Boris Johnson, two men would cement themselves as legends. On paper, they both have so much in common. Both runners, both have their own signature hand move, and both of them dominated their fields at this Games. First, we have Usain Bolt, arguably one of the coolest men on the planet, but undisputedly the fastest. And then we have Mo Farah, the endurance race king. Like trading and investing, you could say these guys do the same thing. They both run for a living. Their aim is to win a race. But I think we both know that that isn't the case. I mean, for one thing, look at how they are built. This alone tells you these guys are very different from one another. Like trading and investing, the difference between these two at a high level all comes down to speed, or in fact, more accurately, time. Usain, like a trader, moves quickly. The opportunity to win is over in seconds, whereas Mo looks to steadily outpace opponents in the same way an investor typically looks to invest longer term. Similar at a glance, but different in the details. Really, you could say that an investor is looking to profit from the price of a business going up over time, whereas a trader looks to benefit from the ups and downs of the market short term. But there is a lot more to it than that, so let's break it down into sections. I want to start first of all with how they pick an investment. The way we pick our investments and the strategy we use to whittle down the selection will ultimately decide how well we perform. Usain Bolt famously said he ate 1,000 chicken nuggets over the course of the Beijing Olympics in preparation for races. I have been following a similar diet in the hopes of upping my fitness, but all that seems to be happening is my clothes are shrinking. I have also been working on my own signature hand celebration. It's a T for Tom. No? I need to work on that. Now, something you're going to need to work on if you fancy being a trader is known as technical analysis. In order to explain this, I need to explain to you that a company really has two different values. There is what is called the intrinsic value. This is the actual value of the business, made up of all its assets, its brand, and its cash flows. And then there is the market value, its share price. This is the value the market puts on the business. Confusing, I know. But the market value can move away from its intrinsic value, so the share price can often become detached from the price the business is actually worth based on sentiment or news or a belief about the business, be it true or not. GameStop was a classic example of this, where the demand for the company from people looking to screw over hedge funds who were forced to buy shares to cover short positions drove the share price to levels way above and beyond what the business was actually worth. So an investor like Warren Buffett will look to value a business and work out the intrinsic value. He wants to know what the business is actually worth. A trader typically looks more at the market price and tries to predict which way that will move. And they do this using technical analysis. You might have heard this called charting, or simply looking for patterns in something that looks like this. Now, while these charts look quite confusing, they really measure things like the price and the volume, or the amount of people buying and selling, and the idea is using this information and studying the past patterns, you can try and predict the future market behaviour. They are using these charts to try and guess which way the market will go short term, up or down. Investors tend to not really care about what the market will do short term and be more interested in the financial statements of the business. Instead of charts, they might study the business's profit and loss statement as an example. It's two very different approaches which both attempt to predict which way values will move. But the value we talk about is different. Intrinsic value for investors or market value for traders. But I think it's important to say that an investor, while they are typically focused on the long-term health of a business and its intrinsic value, doesn't just ignore the short term. As an example, Warren Buffett is a value investor, so he is looking for businesses he thinks the market has undervalued, so the market price is lower than the intrinsic value. He can then pick up these companies at a relative discount before the market realises that they are undervalued. So despite his slamming of traders in the quote from the start, and his often quoted long-term approach, Warren is very much looking to pounce on short-term opportunities. In this case, mispricing as a result of the market not realising the true value of the business. Who's the player now, Mr. Warren Buffett? No, still needs some work, doesn't it? So, to summarise, an investor's style typically looks to bet on the intrinsic value of a business going up long term and its share price with it, whereas a trader looks to capitalise on the fluctuations in the market price short term. Right, next, let's talk about risk. It's common wisdom that the longer you invest for, the less risky it becomes. Pick any day to start investing in the last 50 years and invest for just one day, and the chance of you making money is essentially 50-50. Stretch that timeline out to 13 years and your chances of winning go into the high 90%. But at the same time, it's also true to say if you pick a bad investment, holding on to it for longer isn't going to save you, is it? That thing will run into the ground. But still, trading is seen as riskier than investing for a number of key reasons. Number one, the frequency of trades. Just the simple action of buying and selling more often means traders need to make quicker decisions, and this active participation in the market means people make more mistakes. Number two, trading often incurs higher fees than investing. We incur fees when we buy and sell investments typically, so with higher fees comes a greater need to produce higher returns in order to outrun those fees. The laws of risk and reward state that higher reward always comes with higher risks. To compound this, many traders will use leverage or borrowed money to amplify their returns and in the process add another layer of risk. Number three, traders tend to be less diversified out of necessity. It is impossible to monitor thousands of trades at once, But an investor can own thousands of businesses passively through an index fund, spreading their risk. Investing your money in the hope of growth always carries with it some level of risk, and I would argue a skilled trader is going to take on far less risk than a novice investor who goes all in on meme stocks. But as a rule of thumb, trading is seen as riskier. It is not uncommon for traders to blow up their accounts, trading slang for losing everything in an instant. Bit like our sprinter Usain Bolt, who represents trading in this video, recently waking up to realise he's missing 10 million quid. What's the hand gesture for that, do you think? For some reason, most new investors when they start this game tend to think they need to become traders. Maybe it's Hollywood's depiction of investing, or the barrage of adverts from people who claim to have found a secret trading strategy that always wins. Nice of them to sell that to us instead of just using it, isn't it? Whatever the reason, most people who attempt trading lose money. The stat I found online says 95% of those who try it lose. That doesn't mean you can't make a lot of money trading, but recognise that successful traders require tenacity, an ability to move against the crowd, the intelligence to identify a working strategy, and the discipline to stick with it. Most do not possess these skills, so they lose money. Trends in market movements, up or down, are created by the crowd, by the masses, all buying or selling at the same time. The masses, when it comes to trading, can't all win, so the winnings are always concentrated in the hands of a few skillful, competent traders. I'm not saying you can't be one of those, but understand that fact. And while some cringy 20-year-old will try to convince you this is them from a pool on a laptop, most likely it is sophisticated AI or a hedge fund with all the best equipment and the brightest people on the planet working for them. When you trade, that is who you're running against. And for a few to win, most need to lose. And that is just a feature of trading many fail to grasp. But with investing, this is not the case, and the pack can profit from the long-term holding of a quality business or an index fund over the long run. Watch you don't trip over that pun. Nailed it. Well, I hope that was useful. Whether it's trading or investing you're after, you can do it all on the Trading 212 app. If you're already using it, jump on over to the App Store or Google Play, where you can leave up to a 5-star review for the app just to let others know how good you think it is. Until next time, I've been Tom Morgan from That Finance Show. I'll see you real soon.